Welcome to Talk Tickers. Today, we're digging into Coinbase's Q4 2025 earnings call, and it's a really interesting one. The headline numbers, they look pretty rough, but the company's game plan seems to be holding up. The real story here, the one we're going to unpack, is how the market reacted.
All right, so let's just jump right into the big mystery this quarter. Coinbase drops this massive loss, and yet the stock actually climbs. How does that happen? What in the world did Wall Street see that the rest of us might have missed in those headlines?
And on the surface, these numbers were not pretty. We're talking a GAAP loss, that's the official accounting number, of $2.49 a share. Now, to put that in perspective, the street was expecting a loss of, 5 cents? So, yeah, this was a massive, massive miss.
But then, this happened. Right after the earnings call, in after-hours trading, you'd expect the stock to just fall off a cliff, right? Nope, it actually rallied. It closed up almost 3%, hovering around $145 a share. So what gives?
Okay, so this brings us to the core of it. The key is figuring out what the smart money was looking at. And trust me, it wasn't that big, scary headline loss. They were digging deeper, looking under the hood to see the real engine of the business.
And this really tells the whole story. A tale of two reports. You've got the official GAAP loss, right? A whopping $667 million in the red. But then you look at the adjusted number, and what do you see? A profit, $178 million. This adjusted figure basically strips out some of the accounting noise, the non-cash stuff, to show you how the actual day-to-day business is doing, and that's what the market latched onto.
So where did that giant GAAP loss even come from? Well, it was almost all non-cash adjustments. Think of them as paper losses. The price of crypto dropped during the quarter, so accounting rules forced Coinbase to mark down the value of all the crypto they were holding. They didn't actually sell anything and lose money, it's just an on-paper thing.
Right, so investors basically just shrugged off those paper losses. They looked right past them and focused on what really matters, the operational strength. They saw that subscription and services revenue was still strong, coming in at $727 million, and they really liked the story management was telling about their new strategy.
So speaking of that strategy, let's dive into it. This is what management calls the everything exchange. It's all about making the business less dependent on the wild swings of crypto prices. They're basically trying to build a fortress to protect themselves from the exact kind of crypto winter that caused those paper losses in the first place.
And CEO Brian Armstrong laid it out pretty clearly. 3 main priorities for 2026. Number 1, build that everything exchange. Number 2, scale up their stablecoins and payments business. And number 3, get more people and businesses on-chain, mostly using their network called Base. You can think of Base as like an express lane for the Ethereum blockchain. It just makes things faster and cheaper.
Now this is where it gets really interesting. They are very, very deliberately connecting their Base network to the whole AI narrative. The story they're pitching is that AI agents are going to need a way to transact, and they'll do it on Base. It's a super smart move, right? Tying yourself to the biggest tech trend out there to attract a whole new wave of investors.
And look, this isn't just talk. They're actually building this thing piece by piece. Prediction markets are now live for everyone. They're adding almost 10,000 new equities to the platform this month. They even bought a company called Echo to help with raising capital on the blockchain. The end game? One single platform where you can trade literally everything.
Okay, so that's the grand vision. But how does that actually translate into dollars and cents, especially when the crypto world is still in a tough spot? Let's take a look at what they're guiding for and the bigger picture.
And honestly, their outlook for Q1 was pretty reassuring. Management said they expect subscription and services revenue to be solid, somewhere between $550 and $630 million. And transaction revenue was already at a run rate of $420 million, just a month into the quarter. What this does is it gives analysts a really solid baseline, a floor, for their estimates. It takes a lot of the guesswork out.
And you have to remember the context here. It's absolutely crucial. Look at this chart. Over the last year, Coinbase stock got hammered, down almost 47%. Meanwhile, the S&P 500 is up over 15%. After a brutal crypto winter like that, investors were just starved for any little piece of good news, anything that suggested the worst was over.
And during the Q&A with analysts, one word kept coming up again and again: regulation. Management made it super clear that they see improving regulatory clarity in the U.S., things like the Clarity Act, as a huge potential tailwind. It's what could really unlock the market for them.
Okay, so let's put it all together. What's our take on all this? What's the call for the next quarter? And what should you be keeping an eye on?
All right, when we look at the whole picture, the surprisingly strong subscription business, that solid floor from their guidance, and this really ambitious, kind of risky pivot to the everything exchange, we're ready to put a rating on this stock.
And our rating is market perform. So why not something more bullish? Well, it's a balancing act. On one hand, you have this huge execution risk. I mean, building an everything exchange is no small task. But on the other hand, the stock is pretty beaten down after a terrible year. The strategy makes sense, but the road ahead is going to be long and bumpy.
All right, now for our wild yet plausible trade idea. Let's say you really believe in Coinbase's plan to diversify away from just crypto trading, but you're still nervous about the price of Bitcoin taking another nosedive. You could look at something called a pairs trade. The idea is you buy Coinbase stock, but at the same time you short a crypto ETF. Shorting just means you're betting the price of that ETF will go down. So what you're doing is making a pure bet on Coinbase's business execution while trying to cancel out the risk of the overall crypto market.
And as always, this is not financial advice.